So they've gone and done it. They've put interest rates up by 0.5%. So currently, the Bank of England's base rate has gone from 0.125 up to 1.75. So that's going to cause a lot of anxiety and worry for some people. So I wanted to do a bit of a session today around how that can impact on your mortgage and how that can impact on sort of things around the mortgage market, such as house prices and affordability. So if you've got any questions as I'm going through, pop them in the chat. I'll try to get them all answered. I've had a couple that's come through already, so I will go and answer them. But if you do want to chat afterwards, please just drop me a message and we can always have that chat sort of one-on-one. So the rate is 1.75%. That's the highest it's been in 27 years. And the Bank of England's base rate is basically the rate at what the Bank of England will lend banks and other lenders. So how much it costs them to borrow. And then that will directly impact on what it's going to cost you to lend that money. Currently, we're looking at sort of an average 3% for a 2-year fixed rate. Now, compared to 10 years ago, that was 6%, but it's all relevant because 10 years ago, the mortgage payments would have been a lot lower because house prices were lower, and the difference between the income, so the wages coming into the household and then going, and sort of the outgoings there have kind of had a massive sort of gap. So nothing's keeping up. We've got the gas and electricity. That's had a big impact on cost of living for most households. Council tax, what you're paying at the pump has really increased. So we're just seeing that everything is just getting that little bit tighter, and that's what's causing the worry for people, because it's not just your mortgage payments that's going up, it's your council tax, it's the fuel, it's everything around that. So we're going to have a look at that today to see if we can kind of work through that and come up with any sort of solutions to help people through this at the moment. So if we start with mortgages and sort of products, if you're on a fixed rate, currently you don't need to worry too much because your rate is not going to change because of this change with the Bank of England's base rate. However, there's things you need to be doing. You need to find out when that product does end. You then need to, 6 months prior to that product ending, you need to speak to your mortgage broker. If you don't have one, you can message me and we can have a chat. And what we're going to look at is we're going to look to see if it's best to stay with your current provider or if we're going to jump ship and go somewhere else. But we need to give yourself ample time to be able to do that and make sure we secure the rates at the lowest rates that we can get. If you are on a variable rate, it means that you could see an impact on your mortgage payment. So if it's linked to the Bank of England's base rate, the likelihood is your mortgage payment is going to go up by at least 0.5% within the month or so. And that can really start to impact on the affordability, and that can worry some people. So if that is the case, what I would say is you're on a variable rate, you need to consider whether that rate is right for you. Or if it's right time to fix in and allow yourself to budget. Now, each person is individual, and just because Joe Blogs down the pub says, oh no, you definitely need to go into a fixed rate, that doesn't mean it's right for you. So it's really important that you match your circumstances to your product. As always, if you are looking to change product, you've got to check if the early repayment charges are there, and this is for fixed or variable. If there are early repayment charges, it may not be beneficial to swap rates just yet because it may not be cost effective for you. If you are on the lender's standard variable rate, I can kind of guarantee you by coming off of that and tying into a new deal, whether that's variable or fixed, is probably going to be cheaper because that will be the highest it's been. Over the last year, that's increased by at least 1% for most lenders, if not more. So it's really important that if you are on the lender's variable rate, you get yourself off of that and get yourself onto a new rate because you're probably going to save some money in regards to that. Looking at the affordability side of things, the lenders use what's called the ONS, so the Office of National Statistics, to work out how much they're going to what we call stress tests, so how much it's going to lend you based on what your income is. Now, because of the increases in fuel, that has massively jumped up. So what you could have afforded 6 months ago, you may not be able to afford now, which you're thinking, well, if I'm sitting pretty and I've got my own house and it's absolutely fine. When it comes to a remortgage, you could see that actually what you have been paying and what you could afford, the lender is now classing it as unaffordable for you. And unfortunately, I have seen that if people have taken on extra credit commitments like loans or credit cards during that time. So even if you have a mortgage already, we need to look at the affordability and make sure that when that product comes to an end, you're actually in the right position to be able to remortgage and get the best deal for you. A couple of things you need to be doing in regards to that is, one, you need to check your buildings and contents insurance. If there's anything you've got in there that you're already covering separately, you could look to reduce that down. You need to check your bank statements. Is there any payments you're paying that you really don't need to be paying? Can you reduce that payments down? And also, we need to keep an eye on your credit file, because that is going to dictate what rates the lenders are going to offer you. So don't let your credit file suffer just because you aren't managing your payments correctly. If you are worried about your payments, the best thing to do is get on the phone to your lender and have a conversation with them straight up front, and they can sometimes work with you to make sure that that payment becomes more manageable, rather than adding fees and burying your head. So it's really important we do that. So just because you could afford it previously, unfortunately, it doesn't mean as we sit today that you can afford it at the moment. In regards to house prices, we think it's going to slow down a little bit. So we're seeing the market is starting to sort of become a little bit more stable. The mad rush during COVID has, as I say, slowed down and sort of evened out, and we're seeing that the houses are taking longer to sell. This isn't always a good thing, because that can push demand up a little bit, or it can bring the rates down. But due to the changes in the market, we are seeing less applications going through to the lenders, and then that can then have a direct impact on rates and what's affordable. I guess the good thing, if you're a saver, and I know there's not many out there at the moment, but if you are saving, this increase in the interest rates are going to see that you're going to get more money back for yourselves, which is always a good thing. So savers, you may see some little windfalls coming in your way. Unfortunately, not everyone's in a position to save at the moment, which can be the frustrating thing. So here are a couple of questions that's come through to me already. As I say, if you've got any more, just pop them in the chat and I can try and answer them. So the first one is, will this impact on my fixed rate? Currently, no. As I say, it's not going to impact on your fixed rate, the interest rate increase, but it will impact on what you could potentially be paying once that fixed rate comes to an end. So it's always good to be really prepared. As I say, 6 months before your rate comes to an end, you need to be speaking to your broker about what rate and mortgage you should be going on to. The second question I've got is, they've taken a loan out. Is this going to impact on your remortgage? Potentially, yes, it could, in all honesty, but it doesn't mean you can't fix into a new deal. So majority of lenders will allow you to switch in turn, as long as you can sort of certify that you're able to afford those mortgage payments. They will allow you to switch into a new deal. So even if you're coming off of a product, you can go into a new one, and even if you've taken out extra credit. And then the third one is, will the rates keep increasing? Unfortunately, no one really knows. I guess we're all saying that inflation might get to 13%. If that's the case, rates will keep going up. So that can have an impact on what you're going to borrow overall. So hope that's helped a little bit, guys. But if you do have any questions, as I say, just drop the comments below and I'll do my best to get back and answer them in full for you. What I would say is, at the moment, the time is not to panic. The time is to take action. If you have a mortgage or you're looking to get a mortgage, best thing to do is speak to your broker up front, get your credit file, get your documents over to them, and they can give you a realistic view on what's going to cost you, what the rate's going to be, and what lender types are going to have. Take care, guys.